So if you're like most people, you want to keep your money growing for you. And if you do have an emergency fund, you likely have it in a checking or a savings account with a traditional bank such as Wells Fargo or even Chase. But there are better places to park that cash. Now, the first one is going to be Capital One's high yield savings account, which is going to give you 3.6% annually. Now, this is a very high yield and it's much better than a traditional savings account where you're only getting 0.01% interest. But in this video, we're actually going to go over some ETFs that you can invest your money in. But keep in mind, these aren't investments. This is a good place to park your cash, whether it be an emergency fund or you need that cash to pay off something in the future, or even you're just waiting for an opportunity in the market to buy stocks, your favorite stocks. Now, the first one is going to be SGOV, which is the iShares 0 to 3 month Treasury Bond ETF. And if we take a look at the dividend yield, it's about 4.8%. Now, we do have an expense ratio of 0.09%, so we do have to keep that in mind. But this is going to be giving you mid to high 4%, which is a lot higher than Capital One, which is known for its high yield savings account. And this is going to be paying you dividends every single month. You buy this as any other stock or ETF as you would in a brokerage account. And especially with a lot of brokerages, especially Robinhood, if you are not a gold member, you are no longer getting that 4% interest on uninvested cash. So SGOV is a great option to protect your capital from inflation risk. So if we take a look at the chart, very stable. It's going to stay around, of course, $100 per share. And it's going to have these little dips because of the dividends it's paying out. Take a look at dividend history. Of course, we're going to be paying out monthly. And the cash amount for these dividends are going to vary based on the interest rates. Because remember, this is going to be investing in treasury bonds, so it's completely dependent on interest rates for those treasury bonds. And unlike traditional treasury bonds that you buy from the government directly, your money is not locked up because you can just simply sell this ETF whenever you want and liquidate it. Now, the second one is going to be Roundhill's weekly T-bill ETF, and this is very similar to SGOV. It's going to be investing in a bunch of T-bills. But compared to the other one, this is actually going to be paying you out every single week. So if you have 100 shares of this ETF, you're going to be getting about, 8 cents every single week, which it's going to come out to about between 30 cents and 40 cents every single month. And that's going to be very comparable to SGOV, which is giving you between 30 and 40 cents every single month. But for people who aren't sure when they're going to be selling, say you're going to be selling the ETF before you receive the dividend. That's why week ETF, this is actually the ticker symbol name, WEEK. It's going to be paying out you more frequently, so then you won't miss out on a cash payment. And if we take a look at Roundhill's website, it is going to be very similar to SGOV, where it's going to invest in 0 to 3 month US Treasury bills, and it's going to seek to pay weekly distributions to shareholders. Now, this is very good for a lot of people who are looking for that weekly income, but keep in mind the yield on these treasury bond ETFs are not going to make you rich. It's only going to be giving you mid 4%. So it's a great way to hedge your savings against inflation. And even on Roundhill's website, it's going to be a cash alternative. It's going to give you exposure to those US Treasury bills with maturities between 0 to 3 months. And even though 0 to 3 months Treasury bills aren't a very long expiration, it's always good to know that you can liquidate your position immediately. So it's very liquid. And of course, we have stable NAV. Just like SGOV, the stock price, the ETF price is going to stay around the same, about $100. So you're not going to be losing any money by putting money into these ETFs. And if we take a look at the top holdings of this ETF, it is going to have a ton of short-term US Treasury bills, as we mentioned earlier. Now, the next two are actually going to be mutual funds. They're actually going to be money market funds, and they're going to be brokerage specific. So if you have an account with Fidelity, you can actually just leave your money in a brokerage account uninvested, and it's going to be in SPAXX, which is the Fidelity Money Market Fund. And you're going to be getting a very high yield of mid 4.56%. But it is going to have an expense ratio of 0.42%. But that doesn't matter because this yield is much higher than this savings yield of 3.6. So it's actually very beneficial for a lot of people to actually have some cash in money market funds to hedge your portfolio against inflation. No one wants to lose money just by doing nothing, and this is a great way to park your cash, park your extra savings, park an emergency fund, and get interest on your money. And of course, it's going to be paying out every single month. Now, the next one is going to be very similar. This is actually the Vanguard Money Market Fund. So if you have a brokerage account with Vanguard and you don't have any money invested in the market, you don't have any stocks bought, it's going to go default to the money market fund. Now, a lot of people have actually opened up a Roth IRA. They think that once you open it and you fund it with money, it's going to automatically invest. That's not the case. Your money goes directly into this fund. Now, that's not necessarily terrible, as you're going to be getting about 4.8% dividend yield. This is actually much higher than Fidelity's. So Vanguard is one of my top choices for a money market fund. You're going to get a lot of cash back just by holding this money market fund. For people who are opening their brokerage accounts and funding it, you actually have to buy stocks and ETFs in that account. Otherwise, it goes into this money market fund. Just a disclaimer. And those floor alternatives are a lot better than the current CD rates. I personally have invested a lot in CDs just to prevent my cash that I'm using in the short term is going to be protected from inflation. But we're going to have a 4% yield. If you're not really wanting to buy those ETFs or put your money in a money market fund, Capital One does have some great CD rates, 4%. Now, this isn't as high as it can be, and it's very close to the normal savings rate. But you're getting with that CD rate is you're locking in that rate. Interest rates could drop down tomorrow, and this savings account could be maybe 3% APY, but you're locking in that 4% rate even when interest rates drop. So that's the benefit of the CD. But honestly, with SGOV existing, as well as the new Roundhill weekly T-bill ETF, these are better ways to park your cash because they're very liquid. You just have to sell that stock when you're ready to get liquidated.